So today we are shifting gears, post-midterm content here, and we are starting off actually then talking about the economics of natural resources, and we're going to start focusing on non-renewables today. So basically, in order for us to think about natural resources from an economic perspective, we need to bring natural resources in by thinking about them the same way we think about other things that we manage economically. So basically, if you think about it, like natural resources are a pool of they're sitting over here and they have scarcity. So they are subject to scarcity, I mean, generally they're limited. And so because of the scarcity, then we find ourselves saying, what is the most efficient way to allocate these limited resources? And so the way economists think about natural resources is a viewpoint where natural resources are what we view to as capital assets. So does anybody know, and it's fine if not, but does anybody have a good definition of what a capital asset is? Like, what's the difference between capital? Like, if I own something, like I own this Apple Pencil, but I wouldn't call this a capital asset. So what is a capital asset? Anybody have any guesses? No? All right, so the term capital asset, we usually associate with things that we own for a long period of time. And the benefit we get from them is not from the immediate acquisition of them, but more the benefits they give us over time. So these are more durable items. And so these are like investments. And so when we choose to allocate natural resources, we view those as investment decisions. So this natural resource, from a sustainable perspective, will hopefully be here for a long amount of time. So how do we best maximize our utility from different ways we can use those natural resources when we think about how we're going to interact with them over long periods of time? So that really is what goes on in natural resource economics, is a mapping between the natural resources and another circle, which is like the pie, and how we split them up for different functions that bring us societal utility. So for example, we could say, well, how can I use this natural resource? Well, I mean, one way to use it is for species habitat. So maybe I'll do, all right, so this might be, I'm gonna, species habitat. And you can view that as being like a utility function, I'll call it U1, where we view that as like the amount of benefit we get out of species habitat. I can call that utility 1. That's like one person's utility. Like somebody out there who really is interested in conservation, then if I increase my use of species of the natural resource for species habitat, it will increase their utility. So I can view that as with a utility function. I can also, similarly cut that natural resource up and say that I'm going to use it for recreation. And that might be our other, second source of utility. So you might not care about conservation out there, but you do care about being able to run around in the forest, take jogs, maybe you do, maybe there's a mixture of those two. You do bird watching or something like that. And so recreation would be another use. But then of course, the other stuff is in resource extraction. And that I could call U3. And so we basically, so this mapping that I wrote over here, this here is a resource allocation decision. And if you're a banker, you would view it as a capital investment or capital asset investment decision. So a banker sits there at a bank and looks over all the stocks, and they say, I want to build a portfolio of stocks that is going to guarantee that this bank takes all this money that people have given me. And the money really is the natural resource. So if you view it, you can almost say that, the banker has got these, millions or billions of dollars that you have given the bank just for them to hold on to it. And they got that now. They are not able to use that money because it is your money, but they can temporarily use it. And how do they temporarily use it? They turn around and they invest it in a portfolio of options, each one of those options generating interest, which comes back to the bank. So it is the interest that the bank is making money off of, not the money itself. That's what makes it a capital asset. Similarly, we're allocating these resources. So the earth has given us these natural resources, and we could just use them all up, but then we'd have no earth left over. So just like the bank can't spend your money, but the bank can make decisions about how to allow your money to grow. So we can look out over all of the resources the earth has given us and figure out a portfolio of things to do with that. And that portfolio of things is going to be a portfolio of utilities, some utility going to some activities, some utility going to others. And we seek a socially or economically efficient allocation. So we seek an economically efficient allocation, considering that our social welfare comes from all of these different channels, U1, U2, and U3. And this is social welfare. So that's the basic high-level view of what we're going to be doing in the next couple of lectures, in the next, say, 2 chapters or so, is figuring out a way to really understand how the earth, the natural resources, are a bank, and how we as decision makers are like bankers making responsible choices about investments. Okay, so so today we're going to be focusing on non-renewable sources. So are there any questions about that? I know it's pretty high level. Hopefully it's pretty, in some ways, straightforward, but also kind of abstract. But we're going to be concrete as we start talking about specific things like, how do we model non-renewable natural resources in this way? And how do those models inform when we take oil out versus leave it in, for example? All right. So today, the focus is on non-renewable natural resources. And remember, this non-renewable, if we go back to, I don't know, the first unit, these non-renewables are the ones that had a strong intertemporal trade-off, meaning that use today severely limits use tomorrow. Or if you like, you can view this as rivalry with the future. That's what we view as a non-renewable resource. And so the function here is on scarcity. So why do we have such rivalry with the future? Well, it's because of scarcity. And so so this all comes from scarcity. And as we'll talk about, there are renewable resources like timber, trees, that if you harvest them fast enough, they can't renew and they become non-renewable resources. But we are mainly focusing on examples, just for simplicity right now, like oil and minerals. And then today, we will primarily be focusing on, maybe today and tomorrow and Thursday or next week, we'll primarily be focusing on privately owned. But you should keep in back of your mind that there are non-renewables like aquifers that are not privately owned. And require a different analysis. And we've already hinted at some of that pre-midterm as that this collective action problem. Okay, so so now that we're focusing on scarcity, we need to think about what are the causes of scarcity. And there are ultimately two things that cause scarcity. So there are two causes of scarcity. And the first one, I think, is the easiest to understand. And that's the physical availability. So it's how much is there, and I want to be careful of this next one because I'll just say for now, how much is there? That's all I'm going to say for physical availability. How much is there? And physical availability can change over time. And so as you may have heard over the last couple of days, they have found a significant amount of water on the moon. And so now there is water on the moon, and already they're talking about ways to exploit this new source of natural resource, this water on the moon. So physical availability can change over time. But if you think about it, the water on the moon is not a practical, I guess I would say that, let's say that I said that there were so many billions of gallons of water that was available for humans to use. And then we find out that there's water on the moon. Why can't I immediately add to the stock of water available to us this discovery of water on the moon? Does anybody have sort of why is it only kind of an academic point to find out that there's water on the moon? Why is that not really helpful to anybody now? Any thoughts as to why the water on the moon isn't really actually available?
Maybe because transporting it would be so expensive.
Answers coming into the chat. I'll maybe see if anybody else has got an answer, and then I'll respond. So the answer in the chat so far is we can't get to it. It's not readily available. Transport would be really expensive. These are all kind of what I'm looking for here, is that although the moon water technically exists and we know it exists, it's so hard to get to, and we don't actually know exactly where it is and exactly how to get it, but we know it's there, but that's all we kind of know, that it's practically not there. So that brings up that that there is a second source of scarcity, and that is economics. So there's physical availability is one source, and then there's also you know, economics. There's economic availability, I guess I'll say. And this is how costly is it to obtain. And so both of those two things together really set up how much natural resource is practically available to you. And if you think about it, you know, economics, say we extract or we consume more so long as the marginal benefit is greater than the marginal cost. And eventually, the marginal benefit equals the marginal cost. So then the question is, you know, what if the marginal cost is greater than marginal benefit always? And so in that case, you know, you just never use the resource. So this really shows that there's a barrier, that just like there can be a physical barrier preventing you from getting to something, there is an economic barrier that can prevent you from getting to something too. If the marginal benefits of the water on the moon are not big enough to get around the tremendous cost to getting to the moon, then there's no reason to go to the moon to get water. And so based on that, the water on the moon is just, it may as well be fiction. It does not matter. But what can happen is technological change can alter economic availability. And it can alter it in both ways. It can make things that was available unavailable. So in the case of the moon, if we got a cheaper way to get to the moon and a safer way to get to the moon, then in that case, then suddenly the marginal costs might start falling to the point where they actually go below marginal benefits. And at that instant, I guarantee you, somebody would go to the moon and start harvesting water. But it can go the other way as well. You can have a natural resource that is currently being exploited, but as it gets more and more limited, the price of that resource goes up. As the price of that resource goes up, there becomes more incentive for others to develop processes for harvesting alternative natural resources. And once you have those, then it might change the marginal benefits for the existing natural resource. A great example comes from Britain. Britain used to have, you know, the 1700s, they had an economy that was built on coal. And economists then noticed that as coal became more and more scarce, they were convinced that Great Britain's economy would fall apart because their economy needed an energy source, and the only energy source they had was coal. But as coal's price got slightly higher, then people started developing processes for natural gas, for example, and oil. And the natural gas and oil that became available ended up not only being such that it was economically viable to pursue them as alternative energy sources, but if you remember going back to our old diagrams of where you have, goods, good one versus good two, and you have our indifference curves across those goods, if these goods are alternatives for each other, so if one of these things is coal and one of these things is I don't know, natural gas, then as natural gas gets cheaper, then it's going to change how much you're willing to pay for coal. So as other technologies, even technologies that have nothing to do with the resource you're focusing on, become cheaper, the benefit, how much you're willing to pay for the focal resource is going to change. And that might take something that was previously being mined and make it be effectively economically unavailable after that. So alternatives change this as well. So you never can quite just look at how much is in the ground and say that's how much is there, because what's in the ground is almost irrelevant if you haven't considered the costs and benefits. So we can formalize this. And so there was an effort to do this by the USGS. So the United States Geological Survey wanted to kind of get a framework for understanding these two sources of scarcity. And so the USGS commissioned a study which led to this framework, this Mckelvey diagram. Which you can find in your book, I think it's figure 6.1. And the Mckelvey diagram basically has two axes, geologic certainty and economic costs. And so I'm going to draw these axes, I'll draw them so that they're to match with the book's directions here. Then this axis, it'll be geologic certainty. Where this is effectively a physical limitation. And so more certainty is on the left. And then I've got economic costs in the vertical axis. And so, of course, this is the economic constraint or economic source of scarcity. And so from here in the Mckelvey diagram, they basically built a taxonomy of natural resources, a taxonomy of non-renewable natural resources based on these two axes. And so the first division in this Mckelvey diagram, we'll say is right somewhere here in the middle. And on the right-hand side of this, we have the undiscovered. And on the left-hand side, we have the identified. And so the undiscovered natural resources, then we can kind of group them by whether they are hypothetical or speculative. And I basically could divide up this whole box kind of this way, where the vertical dimension here just has to do with extraction costs. And so you can think of lower extraction costs are going up and higher extraction costs going down. So of the resources that we don't know exist, we've got things that, as an example of what I mean by hypothetical versus speculative, if you think about the planets out there, there are certain planets that based on emission spectra, for example, we can have pretty high confidence that there is a certain resource that's out there, say on Mars. but we're not quite sure it's there. And that's what I group into kind of hypothetical. Then we can have other things where we're not quite sure, like, you hear about speculators, oil speculators. They don't really have a lot of, reason to believe there would be oil in a particular area, but it is an area that no one else is looking in. And so they realize that there's high rewards, even though there's high risk. And so in these high reward, high risk, maybe they start drilling there, and maybe they get lucky, 1 time out of 10, and maybe that's enough to justify this speculation. And at the instant that they find it, then this resource goes from being in the undiscovered category to being in the identified category. So that's one thing. And so this is primarily set by physical, although how much speculation you do is definitely going to be affected by the economic costs of that. Where things get really interesting are under the identified. So these are resources that we know exist, but they primarily due to the economics are not being exploited or are being exploited. So the ease of exploitation is primarily driven by where we actually add them to our stock of a non-renewable resource or not. And so we further group these things into demonstrated versus inferred. And then under demonstrated, we can group that into measured and unmeasured. And so you can have something that you know exists, you found oil there, you just have no idea how much oil is there. And so it can either be measured, you know exactly how much it is, or unmeasured. And then we view of all the demonstrated and inferred resources, all of those things together, we refer to as our current reserves. And so when people refer to reserves, they're referring to this upper section. But there is a lower section down here, which are known, but economically inaccessible. And so, and then, this is, again, the axes here, this is greater geologic certainty is in that direction. And so we refer to these upper tier ones, I'm going to run out of room here. These upper tier ones you might refer to as the economic resources, and these lower ones as being sub-economic. And so these are resources that we know exist, but they are too expensive to use. And so we cannot realistically count them as part of our reserves. The threshold between what's economic and what's sub-economic will change over time. As new technologies come out, then this threshold can move down because you can realistically start using some of these. But as new technologies for other resources come out, then this might go back up. It might become economically unprofitable. So really, you could view this line here as the line where marginal benefit is equal to marginal cost. Maybe I'll write that above the line. And I'd say for extraction. And so down here, you could view this as where marginal cost is greater than marginal benefit. And then up here, this is where marginal benefit is greater than marginal cost, roughly speaking. So that's the Mckelvey diagram, and it's meant to just be a taxonomy of natural resources by their geologic, by their physical difficulty in getting, and then their economic difficulty in getting. Now, the reason why they wanted to make this formal is that you find that when people try to do sustainability calculations for like how much we have left of things, they often forget about these pressures, these economic pressures. So for example, it is common for people analyzing natural resources to use something like a so-called reserve to use ratio. And, or this is also referred to as a static reserve index. And this basically is the current known reserves divided by the annual consumption. And so if you view this as like, you know, resource in units of resource, and if you view this as like resources per year, then the units of this thing is going to be in years. So this is meant to be an estimate of how many years you have left until you run out of the resource. But the problem with these reserve to use, so I guess I could write that down. So this estimates time left until resource exhaustion. But the problem with this is that resource use is dynamic. As you use resources more, you might get new technologies that make it easier to find more of that resource. Or as you use resources more, the scarcity of that resource will end up driving prices for that resource to rise over time, which will generate incentives to find alternatives for that resource. So it is very, very difficult to know, like, yeah, you know, when you have peak society. So, you know, peak oil was sort of very popular for a while. And now, you know, we're getting a big push for electric vehicles, for example. And exactly when peak oil happens, you know, that ends up getting, you know, fuzzy. So it's very difficult to extrapolate exactly when you're going to run out of a resource. And because it may be that that resource becomes irrelevant over time. And the more and more scarce that resource gets, the more and more pressure there will be to find something, an alternative version of that. I'm not saying that we'll solve all of our sustainability problems, but I'm just saying that if for certain types of resources, and this will be particularly the case for privately owned resources, then what we may end up finding is they kind of take care of themselves, and that we don't have to worry as much about the reserve to use ratio, because as you get less and less of the resource, then you'll get changes in technology and changes in availability of other resources, which will totally change the game, at least as history has shown us so far. So, so that's kind of the cautionary note here, is that, you know, but technology and economics can change the reserves. And I already mentioned, you know, example, coal scarcity leads to increase in coal price, which leads to an investment in oil and natural gas, and then that leads to a decrease in use of coal. So yeah, so that's what was kind of being captured in this Mckelvey diagram. So, all right, so are there questions about that? Does that diagram make sense? So far, again, we've been pretty abstract, just kind of the basics of it, no numbers or anything are getting involved. And so as we're moving on here, I want to focus on this increasing price thing and trying to get a better understanding of how that works. Okay. All right, so skipping ahead, let me, I'm just looking at my own notes here to see what I want to emphasize. All right, so let's say we're going back to scarcity. So regardless, let's say regardless of the economics, physical availability will always eventually lead to intertemporal trade-offs. So, you know, or I'll say between use now and use later. So let's think this through a bit. If we only focus on use now, so if we focus on using resource now, not later, then we know the optimal allocation is where marginal benefits are equal to marginal cost. So this is, you know, this gives us a quantity and price just for the current period. So this is the kind of myopic view or nearsighted allocation. All right, so so use this as a benchmark. And then so the question that I have for you is, if we care at least a little about future consumption, what happens to the quantity and price now? So if we do all our decision making based on now, then we are stuck with this allocation of this is how much natural resource we're using, and this is what price we're going to charge for it. So my question then is, if we instead make our decision making so that we do focus on the next period as well, so that we do incorporate the benefits we will get in the future for having access to this resource, then how are these two things, the quantity we use now and the price we charge now, going to change? Does anybody have any thoughts for that? Let's do a breakout room. I haven't done one of those in a little while. So I'm going to say for your breakout room, say how does the quantity and price change as we move from myopic now only to two-period decision making? And so I'll put us into breakout rooms for a minute at most, and have that chat about that, and then come back and then we'll see what you think. All right, so does anybody have an answer they want to share? What do you think happens? Either you can do it in the chat or you can do it from the, uh, or via unmuting your mic. So compared to, so when I said myopic decision making, you're saying we got our natural resource, oil or whatever, and we decide we're going to sell this much of it at this price. And so then my question is, if we now care about having oil or whatever this resource available later too, so we actually care not only about benefits today, but benefits tomorrow, how does that affect the amount we sell today? And how does that affect the price that the market equilibrates on today? And yeah, feel free to either over the, people are putting in the chat, that's great, or in the mics. I'm going to reshare as we aggregate answers.
We came up with the same answer that's in the chat, that the quantity sold would decrease because you were worried about the future periods now having enough of the resource to sell in the future periods, but the price would increase.
All right, so let's see what's we got in the chat here. I see that about Q increasing or Q decreasing since more is needed for future, and P increasing, quantity decrease, price increase, ditto. So yeah, that's kind of what I was hoping that you guys would get at, is that so that so if you've got, one, if you've got scarcity, and if two, you care about the future. And what do we mean by care about the future? What this means is that you have a discount rate that is less than infinity. So so the idea here is that if your discount rate is kind of equal to 0, then that means that you really care a lot. But if it is let's say equal to 25%, you care some. And then if it is equal to 75%, you care a lot less. And so that's what we mean by, a discount rate is it's quantifying how much you care about the future. And the idea here is so long as your discount rate is not infinite, then you do actually get some benefit from the future rewards. And so if you're getting that benefit from those future rewards, then it makes sense that if you combine these two ingredients, then you will use less now, and you will charge or accept, basically charge more now. Or to put it another way, consumers will pay more now. So that's kind of interesting that consumers will pay more now. In the myopic case, so recall, in the myopic case, so where you do not care, so this is where the discount rate is equal to infinity. In the myopic case, then marginal benefit of some quantity is equal to marginal cost of some of that same quantity, and that is equal to the price of the good. And so the marginal benefits and marginal costs equalize. And so you get this equimarginal principle, so that the marginal net benefit, which is equal to marginal benefit minus marginal cost, is equal to 0. So the net benefit of the next unit of good is equal to 0 in the myopic case. Now, what you're telling me is that if we care about the future, we're somehow going to come to a solution where the marginal benefit, so in this case up here, the marginal benefit will be greater than the marginal cost. Or in other words, the marginal net benefit will be greater than 0. And so our supply and demand curves are not going to come to equilibrium right where supply is equal to demand. There is going to be a slightly higher price than we would get if we were just caring about the myopic case. Or to put it another way, there will be a difference between price and marginal cost. So I just want to highlight, and I'll maybe literally highlight it here, that in our normal case here, normally price is equal to marginal cost. That's the normal case right there. That's for the myopic case. Usually the equilibrium price is going to be equal to the marginal cost of how much it is to produce that last unit of production. But when we have scarcity, then the optimal solution we're going to find is that the price will be higher than the marginal cost. So the price will be greater than the marginal cost. This is the case for, this is the non-renewable case. So people will pay more than it costs to produce. And there is a term for that. So when price is greater than marginal cost, then we call the difference, price minus marginal cost, this quantity is called something. So I'll put this blank here for now. And does anybody know what this term is that economists use for the amount of money you can get out of someone that goes above the cost that it cost you for you to produce it? This is not a term that we've introduced in lectures so far. It has been talked about in your book, if you're keeping up with the book.
Is it marginal revenue?
Not well, so that is, so there's, I will say that another term for this is called marginal user cost, which is related to what you're referring to. But I'm looking for kind of a more general term that we are probably all more familiar with even before we took an economics class. So what do you pay? Let's say you live in an apartment. What do you pay at the end of the month?
Rent.
What is it called? Rent, right? It's the economic rent. So rent is a term we use for when there is a difference between the price you pay and the cost it actually takes to produce that, that last marginal unit of the good. And what we find is that scarcity generates what we refer to as scarcity rent, which is also known as marginal user cost. And so whenever I just heard a mic, so I was taking care of it. Whenever whenever you have scarcity generates rent, so you are willing to pay more than how much your landlord pays for. So your landlord pays a certain marginal cost to produce an apartment, and you actually pay the landlord for more than that. Now, if this wasn't if you could find apartments anywhere, then you would not be willing to do that. You know, so it's the scarcity, the fact that there are a limited number of apartments is what causes you to be able to pay rent. If no, what happens though when people see high rents? Well, they flood into an apartment, or they flood into a market, and they try to build more apartments. They try to enhance the number of apartments that are out there and reduce the scarcity. And when they do that, it reduces the rent. If you could somehow make enough apartments to the point at which we don't view them as being scarce, that anybody could have an apartment if they wanted it, then in that case, you would only be able to charge whatever the cost was to run the apartment. And so then your rent would be equal to zero. You'd still pay the marginal cost, but the landlord wouldn't be making anything above the marginal cost. And the interesting thing about scarcity, as you end up using more of a resource, there's less of the resource available later, and which is going to mean that the rents are going to increase. And this is what I'm, trying to, so I'll just write this down to give an idea of the math that's going to come up. Maybe I'll do a little bit of it here because we have some time left, but primarily next lecture. But as more resource is used, then the scarcity rent, which is also the so-called marginal user cost, will increase over time because resource is less available. And this gets us back to thinking about capital assets. If you have a whole heck of a lot of money, you can choose to invest it in different sources and leave them in those sources for a certain amount of time. And as you leave them in those sources, they make interest. And if you're smart about where you've invested them and when you take them out and when you put them in, then you can squeeze those opportunities dry and wring out as much of that interest as you can. And then that you end up making. It is the same thing with these non-renewable resources, is that if you're smart about how you use these resources, not only can you get more than your marginal cost of production by allocating properly this year, but you'll get an even larger scarcity rent next year, because next year's scarcity will be even greater. And you'll be able to basically you'll charge even more and people will use even less. But as they use some of it, the scarcity gets higher. So in the next year, you charge even more and people use even less. You end up making there's a term here known as a price path. And this basically are the sequence of prices charged for a good over time, and in this case, a non-renewable resource, non-renewable. And so this price path, you can think of it as rising the same way a bank account growth. So like similar. And so the oil that is in the ground underneath you, if you privately own that oil, you not only own the raw, like if I sold all the oil today, but if you're smart about it, you can sell a little of it today, make some money off of it, and then sell some of the rest of it next year, make even more money off of it, sell even the rest of it the next year, make even more money off of it. And your extraction decisions will be based on comparison with the bank. So this bank is here. So the optimal extraction of a private resource, I'll say private resource, must be at least as good as returns from alternative investments. So you just have to think in mind, like, I have a choice. I just found so many gallons of oil. I can pump them all up out of the ground as fast as I can, and I can sell them all today and get a certain amount of money. And maybe, marginal cost versus marginal benefit, maybe I pump them all over the ground until my marginal benefit hits my marginal cost. And I can sell all of that. And then I've effectively turned oil into money. So I've just exchanged. So really the price of oil is an exchange rate between two different assets, where one asset is money that I could put in a bank, and the other asset is oil I can put in the ground. Oil earns interest when it is in the ground because you can sell it later. So, private, non-renewable, natural resources earn interest while not extracted. But the interest rate that they earn depends on your extraction rate. So just like you might choose a bank because it has a 1% interest rate, and with the other bank you went to at a 0.5% interest rate, your extraction schedule effectively sets the interest rate of what's going on in the ground. And so what you're going to end up finding, and this is what we'll talk about next time, but then the book is also kind of brings this up, is that there is this thing called Hotelling's law or Hotelling's rule, which basically says whatever interest rate you get at the bank will determine how private owners of non-renewable resources extract from that non-renewable resource there. So basically, if the bank raises its interest rate, then you'll actually get a different level of conservation than if the bank lowers its interest rate. And we will model that more formally next time. So are there questions about this general idea? Again, so next time we're going to actually put numbers to this, where we'll actually put up a marginal benefit, a marginal cost, do the math, and then see what happens from year after year, and figure out how to exactly solve these problems. And I might reintroduce that production possibility frontier, that kind of circle-shaped diagram that we talked about back in Unit C. All right, so any questions, thoughts? All right. All right, well then maybe I could, instead of starting into the example from next time, I might just leave that for next time. So for now, let's just do end a little early and do an attendance exercise. So I'll put that in the chat. And the question I have is, what is the term economists use when consumers accept a price that is higher than the marginal cost of the good, marginal cost to produce the good? And that's all I got for you today. So if you have any questions, I'm happy to stick around. Otherwise, I guess I won't see you Thursday, because Thursday will be the exam, but I'll see you next week, a week from today, and we'll pick this up where we left off.
Professor, I got a question.
Yep.
I don't think I was I don't think it was clear enough for me about the question you just asked for the attendance, so I'm a bit confused on this one.
Well, all I'm asking is, we talked about an economic term that I said was a common word that you probably frequently use, even if you're not an economist. But when an economist hears this word, this small word, it means that a consumer is being charged a price that is significantly higher than the marginal cost to produce the next unit. So when the price is greater than the marginal cost, that difference, that quantity, the difference between price and marginal cost is this term.
Oh, okay. Where price is higher than marginal cost. That one that we talked about recently.
Okay. Yes.
Okay, got it. Thank you.
And there was a question, what did I write at the bottom of the last slide? That was Hotelling's rule. I will cover that next time. It was just a preview that there's a general rule about these how this increases over time. Okay, great. Well, in that case, I will end the meeting, and I hope everybody has a good midterm and a nice weekend, and see you next week.
Thank you. You too.